Can the blockbuster Nvidia earnings report be the unexpected bounce that Bitcoin needed? Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's global macro update, we'll talk Bitcoin price, the money markets, what's going on with the Treasury Department and the Fed. We'll talk about the US economy and big picture narratives. We'll certainly get to Bitcoin's price, but first, our money markets monitor. This monitor has 7 metrics, and I'll go from bottom to top here, explain each of these metrics and the 2 that we'll be focusing on today. In red, you have the Fed's reverse repo program, which you can see is now not utilized any longer. Then in navy, you have the Treasury general account at just below $1 trillion. I have the Bitcoin market cap on there, now below $2 trillion. In gray, you have Fed reserve balances. That's at just under $3 trillion. The purple line there is the overnight usage, the nightly usage of the repo market judged by the SOFR volume. So that is above $3 trillion now. That means that every night there are $3.2 trillion of treasuries that are financed through the repo market, those transactions being used in the calculation of the SOFR rate, which is an overnight financing rate, secured being that letter S for SOFR, secured meaning it is a loan that is secured by Treasury collateral. In green, you have the supply of Treasury bills in the market, and in black, the money market fund assets under management. This is the sum of all those Fidelity and Bank of New York Mellon, JP Morgan and State Street, etc. money market funds that people own basically as a default cash position in their investment portfolios. In order to put these metrics in context with each other and amongst each other, let's talk about the largest number, $7.5 trillion in money market funds assets under management. That can be considered the pool of capital that funds the purple line, SOFR volumes, this is the overnight repo market, and Treasury bills, which are in green. Now, Treasury bills themselves are owned by many other institutional participants outside of money market funds. Money market funds own Treasury bills for sure, but they own a mix of money market fund assets, which basically means fixed income securities that are less than 1 year to maturity. So central banks, governments around the world, corporations, these investors own Treasury bills directly. That is why the quantity of Treasury bills can be so close to the money market fund assets under management, because not all of the green amount is purchased by the black line here, which is money market funds. So the 2 numbers, though, that we are going to focus on today are the navy line and the gray line. This is the Treasury General Account and Fed Reserves. Both Treasury General Account, TGA, and Fed Reserves are liabilities on the Fed's balance sheet. It means that when the government has cash and that navy line goes up, reserves go down because the Treasury is funded from cash within the system, and at the Treasury level, settlement can only happen with the exchange of reserves for Treasury General Account balances. In that way, the gray line and the navy line are going to have a direct opposite relationship as the Fed's balance sheet doesn't change and stays flat. Now, we know that the Fed is currently winding down its balance sheet, that will stop and eventually grow. We'll talk about the growth of the balance sheet soon, but the Treasury General Account reaching just under $1 trillion was a huge impulse for the market, I believe, the last month or so, And we'll talk about now what will happen as that process reverses. TGA growing draws money out of the system in that it shrinks the quantity of Fed reserves in the system. The opposite happens when the government spends money. TGA goes down because it's spending money from its Fed account, and that money basically gets transferred into the private sector via payments out to banks. This is the core of the US dollar onshore financial system. It's settlement between reserve balances and reserve balances at Bank A and Bank B, and it's the settlement of reserve balances and Treasury General Account, Bank A and the government, Bank B and the government. That's the inside movement of US dollar capital. Everything else is bank money or third layer money or deposit money, credit money. Not that the Fed money liabilities aren't credit money, but it's that inside money. It's the inside of the financial system. Now, is it entirely possible that the entire drawdown in risk markets over the last few weeks, including stocks and Bitcoin, was due to a liquidity impulse, a short-term liquidity impulse of the government being shut down, the Treasury needing to build up its balance, and not being able to spend that money down into the economy? Did that temporary liquidity seizure break risk markets and stop any inflow and basically turn momentum negative? It's entirely possible. We'll get to perhaps not prove or disprove that theory, but we'll get to observe whether the opposite will be the case, in that now that the Treasury has officially started to spend down money, you can see that navy blue line has rolled over, albeit barely, but it has. Now that that number is in decline, is that the bottom there in risk assets? Is that going to support a growth in reserve balances that then filters through into the rest of financial markets? Secure your Bitcoin's future and your family's peace of mind. Too many heirs lose access to Bitcoin because there's no clear inheritance plan. Unchained is going to show you how to solve that. On Wednesday, November 19th at 11 a.m. Central, join Dhruv Bansal, the CEO of Unchained, Jeff Vandrew, their chief counsel, as well as the CEO of Gannett Trust, Joshua Preston. In an excellent online event, they will show you how to plan out your family's inheritance. In a free online event, join them for a live fireside chat on how to make your Bitcoin legacy secure and built to last. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever, and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archlending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate. Among analysts, financial analysts, you'll hear a few opinions on this. You'll hear the opinion that there's no direct relationship between reserve balances and the stock market, meaning bank reserves are not used directly to purchase stocks. And so it's a false relationship. It doesn't exist. You'll hear that analysis. You'll hear the complete other side of the spectrum, which is that this inside liquidity is the absolute main driver of marginal trading activity. And when TGA builds, that's going to be a direct hit on the stock market because of inside liquidity flows. And I'm somewhere in the middle, but I think that it's extremely relevant to look at these short-term liquidity flows and the effect that they have on risk markets. Now, I know that there are layers of money, and that when credit money is issued to lever up and participate in financial markets, that credit money, that layered money, is a derivative from reserve balances, for example, or better capital positions at the bank. So I do believe that it's all related. To what extent the TGA drawing down is going to pump stocks or support risk markets, including Bitcoin, over the coming 4 to 8 weeks, it's to be seen. But that's what we do here is we provide you the analysis, and then we will go check to see, did it happen, did it not happen? And our estimate is that the TGA going down should be supportive to, at the very minimum, repo markets, and then potentially also risk markets. Let's take a peek at our corridor chart. This chart shows you the Fed's desired policy window, their ceiling and their floor, their ceiling being the red line, the discount rate, their floor being the reverse repo rate at 375, the ceiling at 4% today. They want to keep repo rates, the orange and black lines, orange being SOFR, they want to keep them inside the corridor. That means their policy rates, their policy ceilings and floors are being effective, meaning that participants aren't going outside of those rates in the repo market, and they're actually just, the Fed is trying to keep them inside. On this chart, you can see the black and orange lines over the last few months have been popping above the ceiling. And yes, these rates are stepping down as the Fed continues to be in a rate cutting cycle. Will they cut or won't they cut in December? That certainly has markets on edge. We are not necessarily too concerned with the Fed's action in December just yet. We don't think it's a big mover on the margin of markets, but whether or not the Fed is going to cut again in December or wait until next year, early next year, that's not the point here. The Fed is gradually lowering rates, but you can see repo rates are creeping above the ceiling. Now, for the last month or so, I've explained that these are warning signals, but not a repo crisis. And you can see here that the repo rates, especially SOFR now, starting to settle down inside the corridor heading into the end of QT. It's also important to bring back that reserve to TGA relationship. As TGA winds down, reserves go up. That is going to be more capital available for those repo markets and should calm repo rates. So perhaps crisis averted. I would lean toward yes, crisis averted here in the repo market. And that's what I've been saying for quite some time. They put in the standing repo facility to prevent crises from happening, because if it's one bank in trouble and it just needs a few days to work out of a position, there's nothing wrong with going and hiding out in the standing repo facility, which we saw usage from over the last few weeks. Here you can see the daily usage of standing repo. It peaked at about 50 billion on an overnight basis there at the end of October and was still active in the beginning of November. But look, since it's calmed, meaning, yes, there was probably a bank or two that needed help. It needed that emergency facility. This is why the Fed put this facility here. And now you can see repo, the standing repo usage has gone back down, as well as the repo rates have gone back down within the ceiling. So we'll keep our eye on repo markets as we always do. Maybe the tightness in repo markets was related to both the Treasury general account build and the knock-on effects to leveraged positions and risk markets. Remember, if participants can't fund their Treasury positions in repo, that means that leverage positions are more likely to get closed out. And so are we going to be moving past this? And is like I mentioned at the beginning, is the Nvidia earnings report that we got today here on Wednesday, November 19th, after the closing bell, is that strong earnings report, which is bouncing stocks and bouncing Bitcoin here at the moment, is that enough to turn the momentum back positive right at the same time that the Treasury is spending down its money? So maybe if we bounce, we'll never know whether it was this AI earnings report that kept the AI confidence going and turned momentum back off of the back of a couple weeks of AI bubble talk, really heightened AI bubble talk that we would fade. We're quite bullish on the US economy on the 5 to 10 year time horizon. In the investment, the capex boom that we've been talking about, we believe that these are long-term effects that will be supportive for the US economy. Not that we're in an AI bubble. It doesn't mean that there can be several companies that have extreme valuations. Remember what happened in the dot-com crisis. These companies like pets.com went under, but amazon.com becomes a multi-trillion-dollar company just several years later. So this current AI wave, it still has legs, and we believe it will be one of the catalysts to continued growth in asset prices. How it filters down into the real economy is a wait and see type of thing. Treasuries owned by the Fed, this percentage number has come down below 10%. You could see 9.41% there. And the Navy line, which is the stock of treasuries owned by the Fed at 3.58 trillion, it's flattening out, but the number keeps going down in terms of the percentage because the supply of treasuries keeps going up. This slope at this negative pace has to end and necessarily will end. The Fed cannot abandon the treasury market because it will go haywire. It doesn't mean that the treasury is reliant on the Fed to get this number back up to 17%. I sincerely do not believe that the Treasury, the US government needs the Fed to own 17% of treasuries. That would be wildly unhealthy. But this number in collapse formation, it does have to turn around. We've been projecting that the growth in the Fed's balance sheet will not be called QE, but will be called something like GDP targeting of reserve balances. That's the name that we've given it for a year or even more since the Fed has been hinting at the end of QT. It seems that the official wordage is out around the growth of the balance sheet. It will be reserve management. Reserve management will be the name of the game. It means that they can't let reserves fall too low as a percentage of GDP or as a percentage of banking assets. Why? Remember what we talked about at the beginning with TGA and reserves, Bank A and Bank B. Bank A and Bank B settling balances to each other requires reserves in the system. The Treasury funding itself from auctions, which happen through the banking system because the buyers have bank accounts. That's the only way they can get settlement of treasuries. You have to have a US bank account that is connected to the Fed's balance sheet, which is hosting the Treasury General account. All of that requires many trillions of dollars of US reserves. Why? Because we know that the Fortress balance sheet, Jamie Dimon at JP Morgan, it's not like they are lending out their $1 trillion in reserves to every other bank that needs it when they're settling treasuries or doing interbank settlements. The risk department at JP Morgan doesn't necessarily want to help every other bank in the system. So you simply need enough quantity throughout the financial system in order to settle interbank wires as well as transfers between the private sector and the Treasury Department. One last chart here on the Fed's balance sheet. This is the Fed reserves plus RRP, which you guys know is now zero, as a percentage of commercial banking assets. So you have the onshore dollar system, and then as a percentage of that, reserve balances, which help move money throughout those commercial banks. And that percentage is now down below 12%. It was as high as 25%. Very abundant reserves. That's why we had so much reverse repo usage there. That reverse repo usage, that was just excess capital. Those were reserves waiting to be materialized into reserves. Moving over to financial markets, make sure you guys go to the bitcoinlayer.com/subscribe, become a TBL Pro today, and gain access to the full TBL experience of our research platform, our research reports, and our incredible dashboard that shows you our TBL liquidity index, proprietary index, and our proprietary indicators that we are deriving using our index. Now, the MOVE index, which is a measure of Treasury bond volatility, is one of the contributors to our proprietary metric. Now, over the last few weeks, MOVE has marched higher, as you can see here on the chart, and joined by a stronger dollar, our metric TBL liquidity has certainly rolled over. It has supported a bearish impulse in the stock market as well as Bitcoin. Anytime volatility picks up, it is a threat to leverage positions, and leverage positions are extremely prevalent in Bitcoin. We've seen mass liquidations. Bitcoin now above $90,000. We are recording this at block height 924,349. And yes, Bitcoin popped a little bit along with the stock market after the Nvidia earnings report. But looking at the green support line that I showed you guys on our last few videos, this is the bull market line connecting October 2023 to August of 2024. The line was basically tagged today in today's session, and while it wasn't exactly touching the line that I had drawn on my chart, it's pretty damn close, and whether or not Bitcoin holds here will be extremely important. I had it at 87,600 today, and it looks like we tagged 88,500. So within $1,000 of that level, Bitcoin's price around this $86,000 to $90,000 level is going to be extremely crucial heading into Thanksgiving week. Looking at Bitcoin and the S&P 500 and their correlations here on the middle and the bottom pane in red and in navy, you can see above 50% there. Bitcoin and stocks ticking together. When risk markets get skittish, these two asset classes basically join at the hip. That's why I opened with the Nvidia earnings report, because what's good for stocks now is definitely good for Bitcoin, as these correlations are extremely high. Forget what you might be taught about Bitcoin being a risk-off asset or a safe haven asset. While you and I might spiritually believe in that thesis, the numbers tell the exact opposite story. Bitcoin and stocks tick together. So we want to see stocks bounce here, and stocks are at close to a support level that I have on the chart, but we really want to see both of these asset classes turn back up. It will be a response to lower volatility. All of that might come with some relief from uncertainty surrounding the Luke Oil situation, which we discussed. It looks like many U.S. energy companies are coming to play and looking to buy those assets. That uncertainty might be starting to go in the rearview mirror. The Treasury general account spend down after the government shutdown ends, and yes, there might be another dance with a government shutdown heading into the January-February time period, but let's not get ahead of ourselves there. These are potential catalysts that can boost risk markets, and we'll just have to wait and see how they open up tomorrow and whether the Nvidia earnings report that we got today can be any sort of catalyst. Bitcoin ETFs had a record outflow this week. That was definitely something that caught our eye. You could see these red bars, and yesterday we definitely tagged the lowest largest outflow that we've seen yet since these instruments have gone live. So liquidations and a fear trade is prevalent in the market. Could that mean that the worst of the selling is over and the most short-term minded ETF holders are now out of the market? Possibly so. And now I have some closing thoughts on strategies product offering, including STRC, the much talked about money market like vehicle that was promising to pay a 10% yield at a par overnight liquidity. Now, STRC broke par in a major way this week, touched the low 90s, and we'll see how the company responds in terms of changing its dividend to try to draw the price back up to 100. But I was shocked all year that I was getting questions about STRC as potentially altering the mindset around a risk-free rate. You can see here that there's no relationship between the risk-free rate in the market today, which is the Treasury yield curve, including the SOFR curve. The SOFR curve now, much like the LIBOR curve used to be, the SOFR curve is the live pricing of the time value of money because it's overnight capital across every single day, month, quarter, and year for the next 30 plus years. That's how interest rate curves are priced out. They're priced out one time period and one forward time period at a time. That's how a yield curve is deconstructed. That is the risk-free curve, not some yield that a Bitcoin treasury company promises to pay. And the yields haven't converged. They've actually proven that the par instrument that you thought it was isn't actually a par instrument. So this concept around Bitcoin treasury companies offering what will turn into a risk-free yield or alter the universe of risk-free rates, that is basically science fiction today. I'm not saying it can't come true. Some science fiction does come true, but that's not the environment we're dealing with, and STRC is a perfect example of this. Now, Bitcoin treasury companies going down much faster in price than Bitcoin going down in price, that is a function of leverage. So that's just the mathematics of a leveraged position. When the underlying goes down, the leveraged trade in this environment, equities, will go down even more. That's what we're seeing there. It has definitely drawn some confidence out of the market and perhaps taken a little bit of froth, necessary froth, out of the market. More important than anything for risk markets will be the rate of change of the MOVE Index bond volatility. TBL pros can monitor that and the way we synthesize that bond volatility into actionable signal for risk markets. All of that available at thebitcoinlayer.com/subscribe. Become a TBL pro today. Thanks for sticking with us for this global macro update. I'm Nick Bhatia for the Bitcoin Layer. We'll catch you guys next time.